In this video, we're going to dive into the income statement in more detail. Remember, the income statement or the consolidated income statement or the statement of financial performance, it all means the same thing. So the income statement comprises of revenues minus expenses, which gives us profit. So revenues arises from sales of a product or services and results in an inflow of assets through either cash or accounts receivable. So cash is when we sell, let's just say, our product outright for cash, or let's say we sell our product today and the customer owes us money in the future, then that's going to give rise to an accounts receivable. Then we have expenses, which are costs of assets consumed or services used to generate revenues. So essentially, expenses is costs incurred, consumed, or used up in order to help us earn revenues. Let's just say hypothetically, we have to pay our employees to make our water bottles, or we have to pay for rent where our equipment is situated on so we can produce our water bottles. So essentially, revenue minus expenses. If revenues is higher than expenses, we have a net income position or a profit position. However, if expenses are higher than revenues, which it could happen, that means we have a net loss position. So I'm going to give you an example of the actual income statement, and this is a single step income statement. In a later video, I'm going to teach you the multiple step income statement as well. So what I highly suggest that you do is you pause this video, get a piece of paper, and as I talk through it, pause, resume, pause, resume. I want you to remake this income statement because one, the formatting is very important, and two, this way you can familiarize yourself with the actual accounts and why they go under each category. So out of the 5 main accounts, we have assets, liabilities, shareholders' equity, revenues, and expenses. Revenues and expenses are the account that go onto the income statement. So as you can see, we have a 3-part title. We have the company name, we have the statement name, and we have the date. In this specific example, they are doing this based off of the month ended October 31st, 2018. So we have 2 columns here. We have subtotals and we have totals. Very important. So the first category we have is that of revenues. So as you can see, we have one revenue, which is indented. We have service revenue. So this company is a service company, and since they have one revenue, we put it directly into this column over here, 20,600. Then we have expenses. Okay, let's actually rewind. Let's just say hypothetically that we had 2 revenues here. We have service revenue and we have, let's say, rent revenue. That means that service revenue and rent revenue will go in this column. Then these 2 add together will go in this column over here. Since we only have one of them, it goes directly to this column over here. So the formatting is very important because it directs your eyes. It's very easy to read these. So when you actually start analyzing real life companies' financial statements, the organization of how these numbers are inputted is going to be very important. Then we have expenses. So we have salaries expense of 5,200. We have supplies expense, rent expense, depreciation expense, insurance expense, and interest expense. So these are all costs incurred, consumed, or used up in our business, the cost of doing business in order to help us earn our revenues. As you can see, we have multiple expenses, which go into the subtotals column. Now, all of these add together gives us 7758. So 5,200 plus 1,500 plus 900 plus 83 plus 50 plus 25 is 7758. Then essentially our revenues minus our expenses gives us our income before income tax. Because remember, income tax expense is calculated based off of our revenues minus our expenses. So in this situation, our income tax expense is 1,800. That means our net income is the difference between the 12,842 minus the 1,800, which is 11,042. So once again, I want you to redo this income statement on a piece of paper so you can start building an understanding of how this works. So essentially, now I want to go back into the formatting a little bit more. As you can see, we have dollar signs now. So we have a dollar sign in this column over here. the very first number. So once you put a dollar sign in the first number over here, that gives the assumption that all of these figures are going to be dollars as well. So the first figure over here is a dollar sign. That means all of these in this column are going to be dollar signs as well. However, this over here has a dollar sign because this is a final figure, the main figure that we want. So that's why that has a dollar sign. So overall, the net income of this business is $11,042, which is a good sign. So we're in a net earnings, a positive position. Now you can see underlines now. The theory behind the underlines is very easy. Whenever we do a calculation, we input an underline. We add all these together. Underline gives us the 7758. Now we're doing the 2600 subtract by the 7758. Underline gives us a 12842. The 12842 minus 1800 underline gives us 11042. Now the 11042 is double underlined because once again, that is the final figure on the income statement.